Hello, welcome to Rural Classroom Live. I'm Albert Liu, joined today by Brien Lundin, president of Jefferson Financial, host of the New Orleans Investment Conference. Brien, welcome to Rural Classroom. Good to see you again. How are you?
Great, Albert. Wonderful to be here, and thank you for the opportunity.
Yeah, it's wonderful to see you again, to get your comments on what's a pretty eventful morning here for stocks. So why don't we start? Why don't we just get into it? The Dow drops almost 200 points today in early trading, Brien, because a hotter than expected CPI number that also affected bond yields. What are your thoughts?
Yeah, hotter than expected CPI number in this topsy-turvy, bizarro world that we're in. Higher inflation typically means that the Fed will be more reluctant to ease monetary policy. Therefore, higher inflation means, according to the algorithm, sell gold. And that's what happened right upon the release of that CPI number. Gold immediately dropped as much as $40. I think it's worthy of note right now, Albert, that gold's up about $4 since that precipitous drop. And so the obvious question is, what does that tell us about gold and what's driving it? And I think very generally, it tells us that there's some very deep pockets that are very eager to buy gold, to own gold out there, whose appetites are not waning and are regularly buying gold and taking advantage of periodic sales like that. I mean, you look at stocks were down, the dollar was up, which would be a negative for gold early on after that CPI number. The treasury yields rose and are still higher now. So that's another typical headwind for gold, yet gold rose against all those headwinds and recovered from its early drop. So it's a remarkable market that we're in for gold. There's big money out there buying it. There's demand that has not been satiated in any way, and gold just seems to want to go higher. And the burden is on other investors and speculators to try and halt that rise, and they haven't been able to do so.
Yeah, looking at the chart now, Brien, you can see it, a pretty precipitous move down early on.
Mm-hmm.
But I think that's the knee-jerk reaction, certainly is what you said, right? Higher CPI suggests maybe the Fed's got to rein in their behavior. But I think there's kind of a more deeper general understanding that money printing is just sort of the world we live in now. This is not going to change, maybe in the short run, but in the long run, it's a necessity, right? It's a necessity to keep expanding the money supply. That puts upward pressure on all assets, and particularly gold.
Yeah, and I think there's a perception that we're in the end game of something. I mean, I've been preaching this for a few years now, that we're in the end game of this 4-decade plus trend of ever easier money and ever greater debts. And you, like me, have as our business, bringing very smart people in front of microphones and podiums and hearing their predictions on what lies in the future, and really smart people with valid arguments. But after a number of decades of doing that, I'm somewhat cynical that anybody really knows anything, at least in any great detail. We really have to have some humility about what we can predict about the future, to any great extent or to any great degree of detail, as I said. But I think smart investors realize that there are a number of scenarios that lie ahead. And in each of those scenarios, you'd want to own gold. It is the protector of wealth and purchasing power in an environment that seems to argue for rapid depreciation of purchasing power of currency. So you want to own it, and apparently a lot of people do.
Yeah, I know what you're saying about the predictions, Brien, but if you think about it, I think what it mostly is that we are impatient when it comes to results, because for a long time, I've been speaking with many of the same experts, and I remember when we were predicting $1,000 gold, sounded ridiculous. Then we were predicting $2,000 gold. That sounded ridiculous. Now we're coming up against $3,000 an ounce gold. So those things have actually happened. The inflation has arrived, and assets have responded just the way we said. Maybe not on the schedule that people want, but more or less you see it playing out the way that that the people who are forecasting did.
Well, Albert, if your argument is that you and I were absolutely correct in our predictions, far be it from me to disagree with you. But I was predicting, generally speaking, much higher gold prices for a number of factors, a number of reasons, which I do believe is accurate. But what I'm talking about is, a lot of the predictions that this is going to happen, and that's going to happen, and this is going to happen in much more detail. I think we're headed for a world of hurt and uncertainty for a number of reasons, but exactly what's that's going to do with markets, I don't know. A lot of people predict that we're in for a major stock market crash. Well, if the Fed decides to embark on a dramatically easier monetary policy, well, then stocks are going to soar. So I don't rule that out, and I don't rule out gold rising along with it. The issue, I think, for you and me in particular, and a lot of people listening to this, is that a lot of the buyers, if not most of the buyers of gold right now, don't buy mining stocks, and to a large degree don't buy silver. So the perception is that those two assets have lagged this rise in gold. What those two assets need are the more speculative end of the investor spectrum participating in. Until now, and probably continuing as we speak, a lot of that speculative money has been focused on tech stocks, the Magnificent Seven, the AI theme, Bitcoin, etc. So we're kind of starved for speculative money flows in the mining stock universe, but I do see that starting to change. I think it is changing as we speak. The GDX since late last year has generally been outperforming gold. And silver, while it was down in one of gold's rallies earlier this week, it's up strongly today, and it's outperforming gold again. So it's interesting, but I think those speculative markets, I think this is the year when silver and mining stocks really begin to leverage the metal.
There you go. You read my mind, because we had a question from Robert Vance early in the stream. Brian, is it time for silver to really shine? Gold has had two spectacular consecutive years. Silver often, rises on the heels of something like that, and it sounds like that's what you're predicting.
Yeah, silver is not bought by central banks and not as much by Chinese investors / savers, and they were the main proponent or propellant rather of the gold bull market in the first couple of months of that market last year, and they remain a very important component of this gold bull market. Silver has passed in a few important technical levels recently. I think it needs to get over 35. At that point, it's pretty clear sailing to the previous nominal highs of around $50. My basic argument for why silver will outperform gold eventually is because it always has in a monetarily based gold bull market. And that's precisely what we're in right now.
Yeah, something you said just triggered a memory, Brian. One sort of long-held belief, or call it even a prediction that I've had, that's been so late that you have to say it was wrong, actually, is that all this inflation we've had going all the way back to the financial crisis, 2007, is that eventually that inflation will show up in consumer prices. The public will begin to hurt, and inflation will become a permanent, will maintain a permanent space in the discussion of politics and finances and investing. And I think we're at that place now, so that if the Fed does do what you said and decides they want to fuel another boom, gold's going to go right along with it this time. Unlike prior stimulus where people, inflation wasn't top of mind. I think now it's different. Do you agree?
Yeah, it's different now because they got a taste of it. A good jolt of 9% annual inflation will sharpen the mind. And that's what happened for consumers in the US. I mean, that's really, I think, what the recent presidential election hinged on. We had that jolt of inflation and the inflation rate came down. But what all the political pundits of a certain political stripe were arguing that the public's stupid because this is a great economy. Inflation's down to 2.5%, 3%. The job market's great and everything else. What they didn't recognize was that the consumer is thinking back to where prices were 2 and 3 years ago and where their grocery bill was. And they did not feel the drop in the ongoing inflation rate. What they were feeling was the accumulated rate of inflation over the past few years. And I think it all hinges on that. I think you're right. It's much more at top of mind in the public, and that's what gold really reacts to. It reacts to public perceptions. At least gold demand fluctuates and is driven by public perceptions of the future purchasing power of their currency. If you look for gold to be a CPI or inflation hedge, it's not going to do that. It's not going to go up and down tick for tick with the CPI and wherever the inflation rate may be, real or perceived. It is kind of a freak out hedge. It's when the public really starts to worry about the future purchasing power of their currency that they start hedging and buying gold to protect their purchasing power. And, it's important to note for people who think that they missed the big gold rally, they're thinking about it as an investor. They should be looking at it as insurance. If you buy gold right now, then you really do maintain, for that amount of money you put into gold, you are retaining whatever the current purchasing power is of your wealth for that percentage. Because again, we don't know the exact path ahead, but we have a really good feeling that 3, 4, 5 years down the road, the dollar, for instance, is going to be worth a lot less. It's going to purchase a lot less than it does today. And if you're confident in that, then you can take whatever disposable cash or wealth you have, put it in gold, and preserve the current purchasing power of the dollar. So you don't miss anything by buying gold now.
I don't think so either, Brien. And even more so, if you look back over the last 2 decades, gold has performed sort of comparable to an equity index.
Yeah,
which is
better.
pretty amazing, right? But if you consider what it is,
Yeah.
it's not even a credit. It's just an asset, and it's
David
performed
Rosenberg
historical gains of the stock market.
Yeah, David Rosenberg had something really great on that. We all know it, but he put it great perspective that even if you have the total yield dividends reinvested S&P for this quarter century of this century, the last 25 years, that gold beats the S&P by like 3,000 basis points. So it has beaten other assets near term, long term, over decades, however you want to dice it. Now, with that said, I am not a big fan of taking 2 asset classes and comparing performance over time periods that I arbitrarily choose, because the old saying that I actually have in Mark Skousen's little green book of Wall Street aphorisms is that I can predict any trend if you allow me to choose the beginning and the end. So I'm not a big fan of cherry picking particular time frames on which assets have beat other ones. But I do think the argument that gold is a dead asset, does not produce returns, is not a valid one, because people misunderstand the true role of gold, and that's to protect wealth. And when you see it in one of these catch-up periods like we're in now, you can invest on that as well alongside that, but primarily investing in the assets that leverage the move in gold itself.
Yeah, and the point of that comparison is not really to position one asset class against another in that way, but if you say that, for example, for the last 2 decades, the return on gold has been comparable to the long run return of the US stock market. The long run, meaning going decades and decades and decades and decades back. That tells you something. That tells you that what we're looking at here in the growth in equity prices and housing prices and other prices is fake prosperity. It's not true productivity. I mean, there's some obviously, but if gold is keeping up, it's like buying a sports car and then like an old man's walking on the sidewalk. He's keeping up with you. There's something wrong, and I guess that's the point. Is that something different is going on in the economy when that happens?
Yeah, I think you're really striking to the heart of the matter there. If you look, for example, if you track the various asset classes like the S&P priced in gold, you see that the S&P hasn't moved for 60, 70 years. It's still at those levels. The implication of that, of course, is that all of those gains have been ephemeral. They've merely represented the depreciation in the currency over that time period. So where has real wealth been built? And we're still on these sugar highs because of monetary policy, with relatively fewer or fewer than we know real advancements in wealth. A lot of that has come purely from technological innovations, where we've seen productivity surge. But all along the way, the steady depreciation of currencies has given the impression, the illusion of tremendous buildup of wealth over time.
Here's a stat for you, Brian. So the S&P delivered roughly 25% in 2024. And so much of that came from 7 stocks that if you remove those from the picture, the S&P only gained 6%. In a year when gold what did gold do? Gold did
27.
Go ahead.
I think 27%.
Almost 27%. So that's your point exactly. The S&P X, the Magnificent Seven, actually lost value when measured in gold.
Yeah, and this is a great time for me to give a plug for a website, pricedingold.com. That's not updated frequently, but it has some compelling charts showing how over time all of these price increases or increases in asset values over time, if they're priced in gold, they really haven't done much at all, or at least not what we think they've done.
Okay, I want to talk about sort of the early days of the Trump administration, but particularly the potential trade wars that are kicking off here. I saw a headline on CNBC, and it said something like Trump's retaliatory tariffs may come as soon as Thursday. I'm like, wait, are we already retaliating against the retaliation? What's going on here? This thing's getting out of control, because that's going to raise prices a lot. And there was another headline that said these tariffs are going to raise the average cost of a car possibly by $6,000 here. That's not going to help, in conjunction with inflation, that's not going to help the consumer, is it, Brian?
No, it isn't. And last Friday, that was a rationale. It was either Friday or Thursday. I think it was Friday. That was the rationale for a big sell-off in gold. And then on Monday, it was the rationale for a big rally in gold. So I think everybody's missing the point here. Yes, it's from the standpoint of the CPI. I think in official measures of inflation, as flawed as they may be, I think tariffs won't help that situation. But the real underlying issue that worries all of the people that are buying gold right now is primarily the fact that debts are too large, and the debts in the U.S. and around the world demand very significant and much more rapid depreciation of currencies, no matter what else happens in the world. So I think that's the big mover behind gold, and the big reason why there's, if there's anything with the administration that is moving the market right now, I think it's the rumors and the perception that the U.S. may return to some type of a relationship with gold as a monetary asset. There's been a talk in mainstream publications now that the U.S. may revalue its gold reserves, currently valued on the balance sheet at $42 an ounce, to something near the current price. And generally speaking, it's important to realize that we have a gold bug now atop the U.S. Treasury. And what does that mean going forward? So I think that's prompting a lot of the physical relocations of gold around the world, from London to the U.S., from the COMEX paper gold markets into physical, into the hands of investors. So I think that's part of what's driving the market. I think that's the real thing we need to look at with this administration, is what's driving as far as what's driving the gold price.
I hadn't heard that one, Brien. It sounds like a gold bug's wet dream. I'm wondering if we track down the source of that, would it lead to someone like Ron Paul or Jim Grant or Eric Sprott, who's actually saying this stuff?
A lot of people. You need to get back on X and get with the cool kids on X and start posting and watching and doing some doom scrolling like the rest of us, Albert. No, it's a pretty big deal. As you know, it's been the gold bug's wet dream for decades. We've
Yeah.
talked about this for decades. Is kind of a very quick way to really help the Fed's balance sheet. And for years, we were talking about it as an important way to immediately restore the Fed's balance sheet and create a lot of money to address the federal debt in one fell swoop. Now it would barely be a drop in the bucket, about $800 billion that would be realized on the balance sheet very quickly, but that would be frittered away, at least in previous administrations, very quickly as well. So I think the important part of that is perception, that it would create somewhat of an official floor on the gold price, which would be helpful, and I think would be helpful for mining stocks. One of the things, or the reasons why some of the mainstream money isn't investing in mining stocks, is that they feel that the gold price could drop precipitously. If you create an official floor under that gold price to any degree, or a perceived floor, then I think you have a lot of money flying into the mining stock market, realizing that these kinds of margins are here to stay. Of course, you and I believe you also believe that. I believe that. But I don't know that everybody in Main Street, or in Wall Street rather, believes that.
That's interesting, Brien. I'm processing this in real time. So if they just revalued the gold price on their balance sheet, it would certainly make their balance sheet look better.
Yeah.
But unless they pledge to buy at any price, it wouldn't put a floor under the gold price in the free market, right?
I think it's perception again. There is a mechanism some have talked about. Now, the Treasury, or the Fed, gave its gold to the Treasury decades ago, and in exchange got gold certificates of some sort. And there's talk somehow that the Treasury could monetize those certificates somehow without actually selling the gold. I don't understand what they're talking about, quite frankly. But there's been talk that they could take that $800 billion and actually turn that into more paper money at the press of a few keys. But if they do, it's still newly created money, newly created currency, like they do every day anyway.
Let's see. Comment from Ada, and he's wondering if a gold revaluation would lead to hyperinflation. I don't see how that would happen. Brien, what are your thoughts?
No, I don't see how it would either. I mean, the value of the dollar, the dollar is, I think, in a lot of investors' minds, still attached to gold, because they see the dollar is not worth its current exchange rate with gold, and that exchange rate will increase in gold's favor going forward. So we're on a bit of a gold standard, but the exchange rate is flexible and determined by the markets every day. And right now, investors are anticipating as I said, a much more rapid depreciation in the dollar, a much more rapid decline in the dollar's purchasing power. I'm not a big believer in hyperinflation. I don't think that's obviously a policy that is intentionally pursued by any government or any real government. I don't think it's going to be pursued in the US, of course. And I don't think it's the kind of thing that we're going to kind of accidentally get backed into. I think we're going to have higher base level inflation going forward. We've seen that the Fed can't get it below 3%. And that was proven again today by today's CPI number. It's surprising to the high side. So, we're probably in a 3 to 4% base rate of inflation going forward, with occasional spikes to those kinds of 8, 9%, maybe a bit more, as we saw happen in the 70s. Not so much to the level of inflation, but the fact that it comes in waves of periodic spikes. I think that's kind of the environment we have going forward right now. I don't think we're going to have hyperinflation, and really, I hope we don't.
Yeah, I think all it does is it really just changes the perceived composition of the Fed balance sheet, makes it look higher quality, but it doesn't really change much, actually.
Yeah.
I got one more thing I want to talk to you about, then we'll get to some of these questions that are coming in for you, Brien. I want to talk about bubbles because I am the ongoing host of the Booms, Busts, and Bubbles panel at the world famous New Orleans Investment Conference. And just a couple of weeks ago, we had something that I thought looked very worrying, and that is the release of the DeepSeek model. And sort of you saw the market processing this, I guess, this change, this innovation, the consequences of this. You saw them processing it in real time and trying to understand whether, like, we really need to spend $300 billion on AI infrastructure. And you see the stocks of all these companies reacting. I mean, this AI has looked like a classic bubble for some time. I want to put up, I actually had a chart for you, Brien. This is from a letter I put out recently to clients. See if you can see that. If you look at this chart, you can just see the bubbles. It's hard to see. I apologize. It's hard to see the dates here, but you have, like, on the left, you have the .com bubble, and then it collapses. Then you have the real estate bubble, then that collapses, and then the longest slope here is that QE 1, 2, 3 infinity.
Mm-hmm.
Then you get a small drop. That's COVID, and then you get the COVID stimulus, and then that last little reversal. That's actually the AI bubble, where you have OpenAI release their models, and then it's off to the races again. And you see NVIDIA stock take off, and you see Broadcom doing well, and Oracle. It looks like that bubble was almost pricked. So what are your thoughts on just what happened in the last couple of weeks?
Yeah, none of those reasons were invalid for reasons to send share prices higher. The dot-com boom was revolutionary, and you would think that equity prices related to that would rise. But there's no idea, no concept, no theory in investment markets, especially in an easy money environment, which we continually had for decades, where it doesn't get overdone. And we're in that, or have been in that stage, where the AI part of it was overdone, and even the Magnificent Seven part of it was overdone. And things will get better, and things will get cheaper. I'm a long-term optimist. The world gets better over time. So it was only a matter of time, I guess, before these expensive AI models would get superseded by something cheaper. And it's scarily good. I mean, some of the examples I've seen are quite remarkable, even absolutely scary. It's like Skynet is not somewhere in the future. It's like right here, right now. And it's going to be a brave new world. What that means for asset prices, I don't know, but you can bet in every case that when there's a theme that hits the market's fancy like AI has. It's going to be overdone, and somebody's going to be left holding the bag at the end. And that's what we've seen. I think it is still very valid, but it's not going to demand, as you say, probably as much infrastructure. But, that infrastructure story was there and was compelling before we had AI lumped on top of it. So I think that story is still great. But some of the high flying AI oriented stocks, I think a lot of air is going to come out of those. And it's happening as we speak.
Yeah, yeah, it is. Okay, let's get to some of these questions then, Brien. And we have some questions about, well, here's a general one to start from Jonathan. He wants to know what platform you use to buy and sell stocks.
I'm not much of a trader, so I'm old school. I was a Rick Rule client back when he was actually manning the phones as a broker way back when. And so I've got my legacy account at Sprott Global where I do much of my trading. I have a couple of accounts at Canadian broker dealers. And in the junior market that, in the sandbox I play in the junior resource market, a lot of what you do, it's very valuable to have relationships. Not only do brokers get deal flow and hear about things that I may have missed or might have otherwise missed that I can bring to my readers. But I can make a recommendation in Gold Newsletter, go buy the stock myself in the market, and through that process, let brokers know of deals that I'm seeing that they weren't aware of, and then they tell their clients, and that helps my readers, etc. So it's a very valuable network. So I guess I don't use a platform. I use really the network that I've built up over decades in this business.
Okay, so full service brokers. And
Yeah.
how important do you feel it is to have something in Canada? Because you could buy those companies,
Yeah, for a U.S. investor, it's still difficult. It's still difficult. As far as participating in placements and getting it cleared, there's very few options left. And most of those options, frankly, have very high minimums. So they're not for everyday investors. Over the last couple of decades, the exchanges and the regulators in Canada and in the U.S. have made it increasingly difficult for U.S. investors to get involved. And I think that's one of the big problems or the big reasons why we haven't seen the kind of reaction that we would have liked to have seen in the junior mining market, kind of like what we saw in the early 2000s. Back then, it was much easier for U.S. investors to participate, and it's a lot more difficult now. And they've been erecting these barriers to protect investors from themselves, but figuratively slitting their own throats in the process.
by the way, Brien, while we're on the topic of Canada, what do you think about this little war of words going on? I don't know if you saw, but you obviously heard what President Trump said about making Canada the 51st state. But
Yeah,
Prime Minister Trudeau was caught on a hot mic saying that he actually believed the threat, thought it was credible.
yeah. Obviously, I spent a week in Canada a couple of weeks ago during all of that flurry of mining conferences up there, and there was a lot of witty repartee going back and forth between me and a number of my Canadian friends. Everybody pretty much agreed that comment that he made to Trudeau was insulting, but the fact that he made it to Trudeau made it somewhat forgivable. But like I told my friends, I said, you keep talking about Canada being the 51st state, but you may end up being the 53rd. I mean, you've got Greenland and Panama, and at the end of this process, we're going to have Puerto Rico saying, wait, what happened to us, But it's funny. It's interesting. It's a bit scary. I like the Greenland idea. I think that's great, depending on how you do it. I think that's forward thinking, and it's not expensive. I mean, you just have to tell the 50 some odd thousand residents of Greenland that we're going to give each of you $1 million to join the United States as citizens. So what you want to do, and leave it at that. It would be fairly cheap acquisition.
Okay, let's move on to some more questions, Brian. Let's see. Okay, so Anonymous asks, any thoughts on what's going on with gold inventories and deliveries at LBMA and COMEX?
Yeah, boy, Anonymous gets around. He has some good questions, he or she. Don't know what it is because he, she is anonymous. Yeah, I I have some thoughts on that. Um, we started publishing, or we did publish Frank Veneroso's um, seminal works in the late 1990s, and called the Gold Book. He put a couple of annual editions, primarily one big edition of it out, where he explained how central banks were loaning out their national gold reserves to bullion banks, replacing that physical gold with IOUs from the bullion banks. And the bullion banks were then immediately selling that gold into the market, taking the proceeds, investing them in US Treasuries, and US Treasuries being such firm collateral, were using that to collateralize much riskier investments on margin. It was a game that was very easy to play in an environment where the gold price was steadily trending lower. And those sales of central bank gold into the market by the bullion banks seemed to guarantee that the price was trending lower. That all culminated in a bottom of around $252 an ounce in 1999 and 2000. And then, of course, we took off from there. But to my knowledge, and from every indication, that gold really has not been replaced in central bank coffers. Now we have a new regime in the White House that's breaking things and doesn't really care what rocks they turn over, and every sacred cow, every secret, it's all being uncovered by this new administration, and again by an administration that has a gold bug as Secretary of Treasury, Secretary of the Treasury. So I think that a lot of this gold is being mobilized, and IOUs are being replaced here and there and around the world, perhaps even the U.S. gold reserve, in anticipation that something's going to happen. And I don't know that the players that are moving this metal have a firm idea of what exactly is going to happen. But in this kind of environment where, the JFK papers are being released, then anything can happen. And it would be good to have gold where it's supposed to be before it happens. So in general, to own gold. So you're getting a lot of players that are taking delivery near record levels off the COMEX and taking that metal. Typically, the entities that are taking delivery in the COMEX are the bullion banks themselves, who then provide gold to the COMEX. They're in the middle. They buy and sell. Now we have buyers only taking money out of the COMEX, taking gold out of the COMEX to a great degree. So it's hard to say any specific aspect of that proves anything, except the big picture, I think, is that gold is being mobilized in advance of a new order, a new relationship between the dollar and fiat currencies and gold. And there may be no bigger plan by the current Trump administration, but I do think that Scott Bessent at the Treasury has some ideas, and there's probably whispers around those ideas out there that's helping to mobilize this gold.
There's clearly a trend in that central banks have been adding gold to their reserves. I think maybe they took a pause one year, but last year over 1,000 metric tons,
Yeah.
my understanding. But did you say that gold was loaned to bullion banks, which then sold into the market, so they were short, and that was never returned? Is that what you said?
Nobody knows. I mean, this was surmised by Frank Veneroso through some really brilliant work, analyzing the statistics and gold flows, etc. There's been no official announcements even of those loans being sold into the market. So there's been no official announcement that it's been returned. But I think that we would have seen a dramatic reaction, kind of what we're seeing right now in global gold flows, if that gold was returned.
I see. So he's kind of doing a black box analysis of the central banks and bullion banks, watching flows and just surmising what must be like in a shell game, what's still there.
Yeah, just I think that a lot of the gold that's flowing right now is ending up in vaults held by investors, whether it's institutional investors, whether it's individual investors, primarily I think institutions, but it's not traditional by any means. We're not seeing big inflows into GLD, for instance, but we are seeing a dramatic increase in deliveries from COMEX, and we're seeing fairly significant shifts in holdings, about 10% or thereabouts, from the LBMA to COMEX warehouses, ostensibly to avoid tariffs or potential tariffs. Well, that may or may not be the case, but I think there's a bigger story underlying all of that, and I think it's gold repatriation around the world.
Is auditing the Fed a pipe dream?
I don't think auditing the Fed is a pipe dream. It depends on your definition of audit. What Elon and his Doge team are doing has faced some criticism, and that people are saying it's not a technical accounting audit, but it is a more general audit of going in and finding out what's going on. For the Fed, I think you could have an actual audit. And if you believe Elon Musk, then Ron Paul is the likely conductor of that audit. Now, I have a hard time imagining or envisioning Ron conducting an audit. He's kind of a big picture thinker. I don't think he's going to delve into those numbers, but his main goal, if he is auditing the Fed, will be to end the Fed. I don't think that's going to happen. I don't think that Trump would get even enough Republican support for that, but it is a laudable goal nonetheless.
That's the thing, Brien. What's happening now, I think, wouldn't you say is selective auditing, targeted downsizing of bureaucracies that really serve no purpose to the people doing the audits, and the central bank helps everyone in government.
Yeah, it's a real audit, and I guess it would better be termed an investigation to me. Because everybody's right. What Doge is turning up is a drop in the bucket. It's not. It won't address any of the big three entitlement programs and military programs that take up most of the federal budget, and so it won't have a dramatic effect on overall spending. But it's still worthy of doing. What gets me is how the political class and the deep state has enriched itself at the expense of the U.S. taxpayer through all of these programs. I mean, you have USAID and the Treasury doling out not millions, not hundreds of millions, but billions of dollars to these NGOs and nonprofits that then pocket the money, funnel it back to their official sponsors somehow, some way, and very little of it gets actually used on the ground. And the part that is used on the ground is advancing causes that the U.S. citizenry would never, by a majority, support. So there's some level, I believe, of criminality here. And I would welcome and hope that there's actually going to be a deeper dive and investigation to where this nonprofit and NGO money actually goes and how it ends up back in the pockets of the deep state, of politicians, and the real estate markets, surrounding DC.
Got a question, another one from Aiden. Brien, is your thesis that at least the gold majors will deliver healthy free cash flow in 2025, given leverage to high gold prices, and then filter down the quality chain?
Yes. Quick answer, yes. Obviously, it gets a little more detailed after that. You have some there's not as many majors out there to start buying up projects from the juniors because of all the consolidation we've seen. And the majors that do remain are distracted right now. You've got Newmont still trying to digest. Newmont's like the anaconda that ate the donkey. It's trying to rationalize all of its Newcrest holdings and figure out what to do with that. So it's occupied. Barrick is somewhat distracted by the situation in Mali. So it's a different market than we've seen before. I think we're going to see more moves along the mid tiers to consolidate and possibly participate in some of these juniors and buy some of these projects. So it's going to be I think a slower project, but they are making a ton of money. The biggest single cost item for some of these majors in their quarterly reports is in terms of royalties, that they have to pay higher royalties because the gold price is higher. It's a problem, but it's the kind of problem you want to have. So they are making money literally hand over fist right now, shovel over shovel. Eventually, they're going to start deploying that.
You mentioned royalty payments. Ahmed has a question. Just noting that won't miners' costs, including these royalties, keep up with the price of gold? This is always a problem, right? You have energy, you have labor, all of these things factor into the profitability of these companies. Seems like a tough equation.
Yeah, there's a lot of factors that go into that. In the 2008, post-2008 crisis, that big rescue effort by the Fed, gold nearly tripled in price from its 2008 lows to its 2011 high. And yet the miners did not leverage that move. They didn't even keep up with the gold price for the first time ever, because at the time oil was going from wherever it started, I forget, but up to $140 a barrel. So all of the diesel, all that was needed to move those big yellow trucks, accelerated even at a quicker rate than the gold price. So miner costs, their OPEX, their operating costs, rose precipitously, and their margins did not expand much at all, if at all, even as the gold price tripled. I don't think we're going to see that now in this instance, because energy is the biggest component. Yes, construction costs have risen. Steel and concrete, steel is going to go up strongly in the months ahead thanks to the tariffs. But that's primarily CapEx costs. It's not operating expenses. The big impact on margins is to operating expenses, and the biggest component of that is energy. And energy prices seem to be very, particularly stagnant right now. So I think margins will continue to expand. And, one of the interesting things you see in an environment like this is that from a producer standpoint, the worst investments are sometimes the best investments, or the worst operators are sometimes the best investments. So the operators whose operating expenses, their production costs, are closest to the gold price, their margins expand at a much more rapid rate percentage-wise, and therefore they often enjoy a greater reaction in the market. We're not to that point yet where the market's actually appreciating that. You have some of the better operators like Agnico Eagle that have outperformed the rest of the market considerably. But it's an interesting phenomenon that we've seen in past gold bull markets.
Yeah, you know what? That's an important thing to wrap your head around if you're new to this sector, and it's something that Rick reminds us of, is that sort of that optionality component to speculating. In that, generally you'll see sort of the least capable, meaning the companies with the lowest margins, react the most strongly to increases in gold, just because of the arithmetic that you point out. Go ahead, Brian. It looks like you had another comment.
Yeah, and one of the things that Rick has and I have as well promoted over the years are the optionality plays in the silver market. In most of these, the ones that we got on very early, like Silver Standard and Pan American Silver and the like, did very well over time because they had great operators, and they found while they were looking for out of the money silver deposits or metal deposits, they happened upon some great silver deposits and other metals, and expanded their business. But there still were and are a bunch of optionality plays out there that have very large resources that when they were acquired were far out of the money and needed much higher gold prices or silver prices to become economic. And in terms of gold, the thing the market has yet to appreciate, and by appreciate, I mean re-rate to proper pricing, is the fact that all of those optionality plays are now not only economic, but robustly economic. And they're not valued as such in the market. So that's an area of the junior sector that I think is going to play catch up over the months ahead. Again, I think this year is one of the year that we really see that begin to happen.
Okay, in from Dawn, do you think M&A activity will increase in 2025?
Yeah, I think it will. I'm not so sure it's going to get to a torrid pace like we saw before, like in the 2000s, for example, for the factors I mentioned earlier, that there's just not as many big players out there. But, balancing against that factor is that they have a whole lot of money right now, and they're making a lot of money right now. So I think it will increase. Depends on how much it will over the next few months. But yeah, I think it will increase, and it's shown signs of doing that.
Okay, again from Jonathan, your take on platinum for the next 2-3 years?
I like the base metals sector, industrial metal sector, for a lot of reasons. I don't think that platinum and palladium, although they're historically associated with gold and silver as precious metals, I think they've lost their monetary aura long ago, and they really are simply industrial metals right now. I like their stories for a number of reasons. Supply issues, even more than demand, the demand side of the equation. But it's two separate stories. I think there's a monetary story for gold and silver, and there's the electrification, the expansion of economics and economic opportunities to the third world, general industrialization of the third world, and still growing auto demand that I think are going to affect a lot of the base metals, and in particular platinum and palladium, as far as auto demand goes.
Yeah, I tend to agree with you, Brian. I don't know much about the monetary history of platinum as an example, but aside from the U.S. minting coins,
Yeah,
and maybe some of the other sovereign mints minting coins, you just don't. It's just really not a monetary metal. Right?
Yeah, it's perception is reality, and decades ago there was that perception, mostly I guess in the jewelry trade, but I think that perception has changed over the years.
Right. Yeah. And jewelry is a direct use anyway. So, okay. We're running out of time. I want to do some rapid fire, Brian, because we have some questions about specific companies. I'll put it up there. If you have something to say, let us know. If you don't, that's okay too. You can pass. So here's the first one up. Perpetua Resources, PPTA. Any thoughts?
Yeah, I really like the play. I know the people working on the financing package, which gives it a dose of reality. I think the name to Perpetua was a mistake from a branding standpoint, because it seems to be perpetually trying to get permits and be developed, and wasn't the best name choice. But I think it's going to happen now. They're actually getting some official money because of the critical minerals component and the environmental remediation component. So I like the story. We don't recommend it, follow it right now in Gold Newsletter, but we have in the past.
Okay. Have you heard of Firefox in Finland?
Yes, I have. Know the guys behind that fairly well. Watched that for years as they were trying to scrape up enough money to advance their projects. I need an update, and to be perfectly frank from them, but I have watched their recent news and think that they've got some great projects. It seems, as if memory serves, they've gotten some high grade narrow intervals but I need to get an update from them. And that's a good reminder. I think I'll try and do that at PDAC in coming weeks.
All right, from Samantha, any thoughts on Nova Minerals and Contango ore?
Not so much Nova, don't really follow the story, but I am very close to management at Contango. I think it's, well, I can tell you that management at Contango believes it's a screaming buy, and I believe that means they are buying in the market. The essential story is that some of the bridges and trucking the ore from Mancho to Fort Knox, where it's milled and processed, some of the bridges weren't quite up to snuff for the weight of the trucks, so they had to reduce the capacity of the trucks by about 20%. Does nothing to the underlying deposit. In fact, it extends the mine life of that deposit by about 20%. So they're making money, a good bit of money, and should be valued, I believe, much more highly than they currently are.
Okay, one more from William. Is Power Nickel's polymetallic resource substantial enough to justify its stock price level?
I haven't looked at its level today. It's been very volatile and on the rise. I recommended the company about a month or two ago because I really liked its strategy of spinning out an illiquid asset to trap the shorts. It seems to have really helped it. It has been generating extraordinary drill results. It is a company that is on the public mind because of great marketing and relentless marketing, but it also has reality behind it. Whether its resource justifies its share price is a question that can't be answered because it doesn't have a resource, but it has extensive, large trend with high-grade results, and it will aggressively drill that trend, just raised a bunch of money. So I like it for the long term, but I would say you would want to pick your spots and don't chase the price on some of these short-term rallies.
All right. Before I let you go, Brien, because we are running out of time very quickly, I want to let everyone know, especially if you're new to us, following us on YouTube or X, Brien is a monthly guest here at Rule Classroom Live. You can check out my live streams with Brien and Rick and Adrian Day and Joe Mazumdar and Joe Littman at ruleclassroom.com. We have a basic membership is free. We also have a premium membership, and one of the features of the premium level is a featured video series we're doing with Brien and the New Orleans Investment Conference, where we feature one of the lectures, one of the talks from a past conference. In January, we had the 2024 Booms, Bust, and Bubbles panel. That's available now. And then next week, we're going to be switching over to another great talk. And this one, Brien, that I've nominated is by Lawrence Lepard. And people who know him know that he is no friend of fiat money. His talk was Fiat delenda est. So he is in the camp of fiat money must die, essentially. I love that talk. Brien, what are your thoughts?
Yeah, Larry has delivered some really compelling and inspiring talks at the conference in recent years, and he is one of the most courageous and eloquent warriors for sound money out there, both gold and Bitcoin. And it really is worth watching. It is extremely valuable, and it will get your pulse racing, I guarantee it.
Yeah, absolutely. So I'll put a link to that in the comments. You can go to ruleclassroom.com, but I will see if I can get, well, actually the link is not up yet. The featured video is still Booms, Bust, and Bubbles, but we'll get that one up next week. Let me just post this for everyone.
And Larry also has a new book out called The Big Print, which I have yet to read, but I'm looking forward to it. That we should probably promote that as well.
Let's do that as well.
Not to make work for you, Albert, but
that's okay. So yeah, there's two links for you, everyone out there. A Rule Classroom and yes, this book. this book by Lawrence Lepard. Great talk. And I did a talk at our Gold Boot Camp, Brien, and I was a little bit critical of Bitcoin. So I'm happy to give Bitcoin equal time. And Lawrence is a great advocate, a great ambassador, I think, for cryptos. And he's, like I said, he's going hard against fiat money. So you got
He
to love
is.
that, no matter where you stand on the.
And he'll take an argument against Bitcoin as long as it's not coming from Peter Schiff, apparently. So.
Okay, and also Brien comes to us via Jefferson Financial and his publication Gold Newsletter. So I think a plug would be appropriate here, Brien. I'd be insulted if you didn't plug it to our great audience here. So what is Gold Newsletter? How can people get involved with that?
Gold Newsletter is the longest running investment advisory in precious metals and mining stocks. I think it's actually the longest running investment newsletter in the world. This is, we're in I believe, our 54th year right now. And you can find out more about it. It's the best value, I think, out there among newsletters in this sector. And you can find out more about it at goldnewsletter.com.
Okay, awesome. And one last thing, I'm going to be in Las Vegas next week with a friend, Mike Larson. I don't think I'm going to see you there this time, Brien. Is that right?
That's right. It's a great show, by the way. You and I have talked together there before. But it's a great show. I just can't fit it into my travel schedule this year.
Yeah, and I'm excited because the Money Show really caters to all kinds of investors. And if you follow them, they have speakers on everything from just, the broad equity market to alternative investments, real estate, leverage strategies like options. But what I like is, when this general market starts getting involved and interested in gold, which seems to be happening, Brien, that is a good sign for everyone in the sector, don't you think?
Absolutely. And it's happening more and more. I think it's happening around the world. It is really not U.S. investors yet. It's investors around the world. And I think that really spells opportunity, because when the U.S. investors get into this market, that's the fuel that's going to drive it again to much higher levels.
All right, let's leave it at that, Brien. Thank you for joining us again. Thank you for staying a little late. Hope everyone will join us at ruleclassroom.com for more content and also those special featured videos from the New Orleans Investment Conference. Until next time, Brien, thank you and take care.
Thank you, Albert. Thanks, everyone.